Hi, I'm Bryce Battershell with Covenant Defense Life Group. Today I want to break down life insurance in a simple way. Life insurance is usually rated on three major things: age, health, and gender. The younger and healthier you are when you apply, the better your chances are of getting a lower rate. And yes, typically men are more expensive to insure. Part of that is based on mortality statistics. And part of it might be because some of us do crazy things, like throwing 100 bottle rockets into a campfire and saying, "Watch this." But let's keep this simple. There are three basic types of life insurance: term life, whole life, and universal life. The first type is term life insurance. Think of term life like renting a house. You sign a contract for a certain period of time, usually 10, 20, or 30 years. During that time, your monthly payment is usually pretty affordable. It is simple, budget-friendly protection. But here's the catch. When the term ends, the contract ends. Now you are 10, 20, or 30 years older. If you still need coverage, you may have to apply again, and now the price could be much higher. Even worse, your health may have changed, and you may not qualify the same way you did when you were younger. So term life can be a great solution for people on a budget, young families, mortgage protection, or someone just starting out. But it is not the only option. The second type is whole life insurance. Whole life is more like buying a house. It costs more than renting, but you get benefits that term insurance does not provide. Whole life is designed to last your entire life as long as the required premiums are paid. That means you do not have to prove insurability again later. It can also build cash value over time, and that cash value may be available through policy loans or withdrawals. Because of that, whole life can show up as an asset on a personal financial statement. Now, there are financial considerations. Whole life usually has higher premiums than term life. For example, and this is only an example, if term life costs $50 a month for 30 years, that equals $18,000. If whole life costs $250 a month for 30 years, that equals $90,000. That is a $72,000 difference. But here's the question: when the term policy ends, will you still be insurable? And if you are, what will the new payment be? With whole life, the goal is permanent protection that does not disappear just because you got older. The third type is universal life insurance. Think of universal life like rent to own. It is permanent life insurance, but it has more flexibility than traditional whole life. Part of your premium pays for the cost of insurance. The other part may go toward building cash value. For example, if you pay $75, part of that money helps cover the insurance cost, and the rest can go into the cash value side of the policy. Over time, the cost of insurance can increase as you get older. So later in life, that $75 monthly cost may need to become $250. But if the policy was funded properly when you were younger, the cash value may help cover some of those future costs. In simple terms, you may overfund it when you are younger, so you have more flexibility when you are older. That is why structure matters. A poorly designed policy can become a problem. A properly designed policy can become a powerful tool. There are three main types of universal life policies. Number one, traditional universal life, or UL. This usually grows based on interest credited by the insurance company. It is generally more conservative and may be tied to the company's general account, often made up of lower risk assets like bonds. It is usually safer and more predictable, but the growth potential may be limited. Number two, variable universal life, or VUL. This is tied directly to market-based investment options such as sub-accounts. There may be no cap on the upside, but there is also market risk. If the market goes down, your cash value can go down too. Number three, indexed universal life, or IUL. This is tied to the performance of an index like the S&P 500, but you are not directly invested in the market. An IUL may have a cap, meaning there is a limit on how much interest can be credited. It may also have a floor, often 0%, meaning if the index goes negative, you do not receive negative index interest. But remember, policy charges, loans, and withdrawals can still affect the cash value, so it needs to be structured correctly. Why some people like IULs? Here's what I like about an IUL when it is designed properly. First, it can create potential tax-advantaged retirement income through policy loans and withdrawals. Second, it can be useful for higher income households that want to put away more money after they have already maxed out other retirement options. Third, it gives you downside protection from direct market losses because of the index floor. And fourth, it is still life insurance. That means your family can receive a death benefit if something happens to you. A 401k, Roth IRA, or brokerage account may help you build wealth, but life insurance is designed to protect your family if you are no longer here. So here is the real question. Are you only looking for the cheapest coverage today? Or are you looking for a strategy that protects your family and gives you options later? Term life, whole life, and universal life all have a place. The best policy is not always the cheapest one. The best policy is the one that fits your age, your health, your budget, your family, and your long-term goals. At the end of the day, it is your life. How much do you want to invest in protecting yourself and the people you love?